users using the Markowitz model that he won the Nobel Prize. The optimization is embedded in the Excel, and I'll walk you through that, okay? But this is basically the theory behind it, okay? And this is a multi-asset portfolio. I can apply this portfolio theory to constructing a portfolio of stocks. I can do it in constructing a portfolio of bonds. I can do it in constructing a portfolio of stocks and bonds. Stocks, bonds, and real estate. Stocks, bonds, and insurance. Stocks, bonds, and currency. Stocks, bonds. You can put together, different asset classes within the portfolio to create diversification or returns within the portfolio. Okay. So this is how I would approach it if I was doing this, and I'll walk you through. And what you should do is draw this out in your book or on your notes as I'm doing it. Okay. So draw it out as I do it. Okay. And follow along. Because again, here, this is another practice for you. Okay. Because they're going to be asking you for writing samples. They're going to be asking you for projects. They may ask you for notes. They may ask you for looking at your deliverable. If you don't have any work product from your academics, how are you going to show them the type of work that you can do? Okay. The deliverable that we do in 123 and in these classes have been used for interviews at Tesla and some other companies, and the people have gotten the jobs because it's a portfolio of work that they can show. Okay. So they're going to look through the stuff. Okay. And it's attention to detail is what they're looking at. Okay. How does it look? Does it make sense? Is everything look correctly? Or is there attention to detail? Okay, that's what they're looking for. So you need to retrain your brain to really focus on the detail. Okay, and really focus on quality at this point. So the first thing I would do is I would set out the graph. Okay. So I would start up here. I would go like this. Like that. That would be my first step. My second step would be I would set up here. This is the portfolio standard deviation. And this is the expected return on the portfolio. Okay. And then the third step, what I would do is I go right here. This is the risk-free rate. You can use the 10-year treasury yield. T-bill, yield to maturity, this is the risk-free rate, it's going to be positive, okay? Or it was historically in Japan and in Europe, it's negative, okay, which was the second question on that problem. And then what you want to do is you want to go from here and go out like that, all the way up, and that line right there is the capital allocation line, the CAL. That's the capital allocation line. The next thing that I would do is the efficient frontier. You go right here and draw out the efficient frontier. Put a dot right there. Put in the umbrella, like this, and make sure that this dot, that I can put the dots like this. Put the dots like this. Same thing down here. This dot right here is above the risk-free rate. So it's a little nuanced, but it's correct. So here, then, what I would do is right there. Then what I would do is I would put dots here, 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 and there. So these dots, I'm going to put a dot here, 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 and here, and there. So these dots along the efficient frontier and at these points, the umbrella, and these dots within the efficient frontier are feasible portfolios that you can construct using assets within the investable universe. Okay? So I can actually construct those. Right? I can't construct a portfolio up here. That's totally infeasible, even though that's what you want. I want a portfolio of high return and very low risk. Doesn't it? There's no such thing. Okay. There's nothing in the market. I can't construct that portfolio. It's totally infeasible. Okay. then the next thing that I would do is go right back right here, and I would draw the first utility curve. I would draw the next utility curve, and then the next utility curve. This would be U1, this is U2, and this is U3. Now, investors want to be up here, right? They want to be there. They want to be on a higher utility at lower risk. They can't do it, okay? So what they're going to have to do to get to portfolios that actually they can invest in is they're going to have to lower their utility. They're going to have to lower the utility curves. And in the chapter, you calculate these curves and you calculate these utilities. So they're going to have to lower the utilities to the point where the utility curve is tangent to the capital allocation line and the efficient frontier. At that point, this is the market basket. So if I looked at all the investable assets in the universe, added up all the values, divided them back, and I came up with the weights. The weight for stocks, the weight for bonds, the weights for real estate, the weights for derivatives, the weights for whatever. That would be the market basket. That would be the portfolio weights that I would replicate to get to here. And at that point, that portfolio and that portfolio allocation is going to give me the highest expected return at the given level of portfolio risk. So that portfolio allocation right there is going to maximize my expected return on the portfolio and at the minimum portfolio risk. So my risk-adjusted rate of return is going to be maximized at that portfolio right there, that portfolio allocation. And I'll go through the allocations of how these allocations have looked historically over time as professionals like myself, well, advisors, historically have constructed these portfolios on behalf of retail and institutional clients. Okay, got it. What we can do too is I get a client that says, hey, I'm willing to take risk. I'm willing to take more risk. I'm willing to take more risk because I want a higher rate of return. Okay? So what I can do is I can sell off my bonds and I can buy more stock. And actually this portfolio right here is 100% stocks. So it's going to give me a high rate of return, but it's also, I'm going to have to take on a lot of risk, a lot more risk. But if I want, what I can do is if I'm willing to take on the risk for a higher rate of return, I can sell off my bonds and I can increase my allocations to stocks. I'm going to get a higher return, but I'm taking on more risk. Okay. I could also be an investor that says, hey, you know what? I don't care about the return. I'm just worried about risk. Minimize my risk. I'm willing to take a lower rate of return to get less risk. So I'm really risk averse. So what I'll do is I'm going to sell off my stocks and increase my allocation to bonds. I'm going to move down the efficient frontier into the most extreme condition. I'm going to have 100% of my portfolio in bonds. I'm going to have lower return, but I'm going to have significantly lower return. Risk. Okay, so I can do that. What I can also do is I can jump off the efficient frontier up onto the capital allocation line. And what I can do is through the process of leverage, by adding margin to my stock portfolio or adding mortgage financing to my real estate, I can jump off the efficient frontier and move up the capital allocation line and get significantly higher return, but I'm taking on significantly higher risk through the use of leverage. Because when you use leverage, margin, or mortgage, it increases the volatility in the net cash flows. Okay? So you're introducing more volatility into the portfolio to get a higher rate of return. Okay? What I can also do is I can jump off the efficient frontier down here, and I can move down the capital allocation line through the process of lending. And this is what banks do. Banks are more concerned about reducing risk. Okay? They're willing to take a lower return for significantly less risk. And the way that they do that, for example, I opened a margin account with a brokerage firm. If Apple stock goes down and I don't put up margin, they're going to liquidate the stock to pay back the loan. Okay? Margin is just a loan. Got $100,000 in equity, want to buy $100,000 of Apple. I go to the brokerage firm and say, hey, give me $100,000, I'll pay you 9%. Okay? Now I'm controlling $200,000 instead of $100,000. I buy $200,000 worth of Apple stock instead of 100. And if Apple stock goes up significantly, my return on equity goes up exponentially. If the stock goes down and I use margin, then my rate of return on equity is going down exponentially. So margin and leverage is a two-edged sword. If it's moving positively in your direction, you're going to make a lot more return. If it's moving against you, you're going to lose a lot quicker. So what the lenders will do is they will lend you the money, and the brokerage will lend you the money, but the stocks and the real estate are collateral for the loan. And if you can't pay off the margin, they're going to liquidate the stocks to pay off the loan. If you can't make the mortgage payment, they're going to foreclose on the property, and they're going to sell the property to basically extinguish the loan. Yes?
So they need to have collateral if you are to say go for margins.
Through lending, the way they mitigate the risk is by lending, but the loans are collateralized by the underlying assets. So you're pledging the assets.
So you have to prove you have those underlying assets before you can buy.
Yeah, you're going to say, well, I can go to the brokerage firm and say, hey, I want to buy, lend me $100,000 for Apple. Apple's the collateral for the margin. Give me, I got $300,000 for $1 million loan. Bank, lend me $700,000. But what I'll do is I'll pledge the real estate as collateral for the mortgage. And if I default and I can't pay it, then you guys will foreclose, take the property, liquidate it, and pay off the loan. Okay? So the collateral piece is what makes it less risky. Okay? What else? Let's talk about, before I get into the other stuff, let's talk about the model, the market basket. It's also called the model portfolio. It's also called the target portfolio. Okay? That's what you guys are doing in your exercises. You're coming up with target allocations to basically come up with the model portfolio or the target allocation. Right? So historically, when I was in the business in the 1930s and 40s, when we were building portfolios for our clients, mainly of 70% bonds and 30% stock, because those were the assets that were available to us in the universe. So we were limited. In the 80s and 90s, what happened was Ibbotson and Associates did the research around this and came up with an allocation, republished the allocation, the recommendation to the institutional community that basically said that you need to introduce direct private equity real estate into your stock bond portfolio. One, because real estate makes up a significant portion of the investable universe out there, and two, that real estate returns have low, no, and negative correlation with stock bond returns. So you're going to get diversification by adding real estate to your stock bond portfolios. Okay, that was huge. That institutionalized real estate investment during that time period. And then in the 1990s through 2000, Ibbotson did the same research on this and said, hey, not only should you have 10% of your allocation in real estate, because we're going to take it from bonds, but also you should have 10% of your allocation in cash value life insurance, particularly from mutual insurance companies. And the banks totally institutionalized it. What the banks did is they said, okay, what we're going to do is we're going to slap permanent life insurance, cash value life insurance policies on every single senior executive within the bank. And the bank's gonna fund those life insurance policies. And over time, cash value is gonna build in these policies. And the cash value by the regulators said, hey, that cash value is so secure and so liquid that we're gonna count it as tier 1 capital for liquidity requirements for regulatory purposes for the financial institutions under examination. So that institutionalized cash value life insurance, not only at the institutional level, but it had already been adopted by high net worth individuals going back 167 years, particularly the extreme wealthy out of Europe and on the East Coast. So it had already been institutionalized at the retail level, but not at the institutional level or financial institutional level. So that was huge. And then the current model target portfolio that I came up with, in conjunction with some research that had been done with Deutsche Bank Reef, basically said, hey, let's rerun the analytics, and what we should do is not only have 10% in real estate, 10% in cash value, but 10% in alternative renewable assets, because that's the next asset class that's being starting to emerge in the marketplace. So we took again another allocation from the bonds. These are all long-term economic lives. These have long-term maturities. Their returns have low, no, and negative correlation with stock bond returns. And these alternative renewable asset classes right now are emerging, and you're starting to see institutionalization at the policy level, particularly in the state of California. The state of California said, what recently under Brown, that we want to have zero emissions, zero carbon economy within the next 30 to 40 years. So capital is forming and capital is being deployed at the institutional level into utility scale solar farms, geothermal, biogas, all of these alternative energy assets. They have long-term lives. The returns are extremely stable. They have low, no, and negative correlation with stock bond returns. So if you add, this is the key to the whole thing, if you add these alternative assets, and these are extremely popular these days, this is an emerging, alternatives are an emerging asset class. If you add these alternative assets to your stock bond portfolio, because they have no low and negative correlation with stock bond returns, what happens is the efficient frontier bows out. It bows out the efficient frontier. And actually some of the research that I've seen, which I'm still pretty skeptical of, they actually said that not only does it bow out, but it actually increases the rate of return. So it reduces the risk in the portfolio, but also increases the rate of return. That sounds like fire or water, too good to be true type of invention. So to be conservative, I'm just gonna say, okay, it just bows out the efficient frontier. Well, when you get a bowing out of the efficient frontier, what you're gonna get is you're gonna get lower return, lower expected return within the portfolio. Yeah, Wes?
So is investing in alternative renewable assets, is it like just like any regular loan where you invest in some of these assets on the
No,
condition that
unfortunately, your generation currently is limited to the access to these institutional utility scale alternative renewable assets. A lot of the alternative renewable asset companies have not gone public yet. There's a lot of private equity, but you're not an accredited investor.
Right.
Okay, so you can't get access to this asset class. Okay, the institutional investors can, but you can't, as of today. In 20, 30 years from now, you will have access.
But hypothetically, if I did have an institutional investor license, could I, how would you get money back from alternative renewable assets?
What I would do is, for one, what I could do is I could look at the Reg D filings of private equity. Okay, they're called Reg D filings. There's a database, a website if you want to go up there. It's called capitalbrain.co. Capitalbrain.co. Okay, that's the company I work with. We track all the private equity Reg D filings for real estate and also alternative renewable energy. The sponsors of these investment funds are Deutsche Bank, Reef, Carlyle, what's the other one? Merck. There's a bunch of private label, private equity, institutional investor advisors that basically put the strategy together, go out to the institutional community, raise the multi-billions of dollars, and then basically go out and buy power plants, buy basically wind, solar farms, biogas farms. They go out and actually buy the assets and put the alternative assets within a portfolio and manage the alternative renewable energy assets within a portfolio. And I've been working on that for the last 10 years too. Okay, so if you want to talk more about it. But the key to the whole thing is that it bows out the efficient frontier. And what happens is you get a reduction in the expected return, but you get a significant reduction in the portfolio standard deviation because of the low, no, and negative correlation of the returns with the stocks and bonds. So what happens is at this point, if you look at it, if you put together the return to risk ratio or the risk adjusted rate of return ratio, you have the expected return on the portfolio divided by the portfolio standard deviation. By adding alternatives, it'll probably reduce the expected return within the portfolio, but it's going to reduce the portfolio standard deviation even more, which means that the risk-adjusted rate of return of the portfolio is going to go up. And if you can get a higher risk-adjusted rate of return, risk-averse investors are going to love it, okay? They're going to love it. So through asset diversification, I can reduce the portfolio standard deviation significantly to increase the risk-adjusted rate of return. And if I'm a good asset selector, and if I'm a good portfolio manager, and I got a track record that basically shows that based on the portfolios that I've constructed in the past and based on the portfolio strategy that we've laid out for you, we can get an 8 to 10% rate of return on our portfolio going forward based on our track record. And if I can lock in that expected return on the portfolio, if I can lock in this expected return at 8 to 10%, and I can reduce the standard deviation, if I can increase the risk-adjusted rate of return and lock in the 8 to 10%, if I can give my investors 8 to 10% rate of return, I can double the value of the portfolio in less than 10 years. That's all they want. So if I can give them the 8 to 10, I can do the diversification, reduce the portfolio standard deviation, and increase the risk-adjusted rate of return in the process. The money's going to flow into our company and into these portfolios, and we're going to make a shitload of money under assets under management. Okay, we're going to be charging fees, acquisition fees, disposition fees, asset management fees, promotes. We'll probably be able to get a percentage of the performance above a certain hurdle rate if we can outperform what we said we can do. So there's a lot of money to be made, particularly in these private equity spaces, but it's really complex, it's really hard, it's really opaque. It's not like managing a stock bond portfolio, which is easy, okay? What else? Last thing, okay? So I can bow out the efficient frontier through diversification by investing in alternative assets. That's modern portfolio theory. I can also bow out the efficient frontier, lock in the expected return, and reduce the portfolio standard deviation, and increase the risk-adjusted rate of return through financial engineering. I can do it synthetically by using derivative contracts. So I can use it by using derivative tools. Do the exact same thing. That's postmodern portfolio theory. So if I think that the value of my assets within my portfolio are going to go down, or the rates of return are going to go down or turn negative, I need to hedge off that market risk. How do I hedge off the market risk? By the use of derivatives. Okay? So if I have assets within my portfolio whose values and returns are highly correlated to indexes, and the indexes have derivative contracts that have been written on them, I can use them to hedge off the market risk if I have the correlation. For example, I'm gonna have ETFs in here, I'm gonna have real estate in here, I'm gonna have stocks and bonds in my portfolio. I can go out and find stock bond indexes. I can go out and get, invest in derivatives based on those indexes, just as long as there's correlation with my assets and the indexes, I can use the derivatives. So if I think the returns are gonna go down and the values are gonna go down, and the indexes have correlations with my assets in my portfolio, I can write forward contracts, I can write futures contracts, I can write calls on the futures, and I can buy puts on the futures using the index derivatives to hedge off the market risk. I'm gonna have ETFs and I'm gonna have stocks in my portfolio, or bonds. If I think that they're gonna go down, the share prices for the ETFs, the stock prices and the bond prices, mainly the ETF prices and the stock prices, if I think they're gonna go down, I can sell short the shares, I can write the calls, and I can buy the puts. So what I'm doing is I'm hedging off the market risk by using the derivatives, applying the portfolio insurance, and I'm financial engineering the bowing out of the efficient frontier. Okay. Last piece, okay, and then I'm done. Here, this is the thing that I don't think everybody understands. Right here, the cash value life insurance. Okay, I'm an individual, I got clients, I got principals that I'm working with. These people are exceptional individuals. They have multiple corporations. They got multiple startup companies that they funded and they're advising. They sit on boards of nonprofits. They run basically their own family office, and they invest on behalf of their family and other families and friends around them. The individual has huge human capital, has intellectual property, his intelligence. His or her value is huge in the process of adding value across multiple networks within the network. What happens if the individual passes away? Hugely destructive, huge destruction of value. The startup companies could fail, the nonprofits could fail. The companies that he or she are running will be impaired with value because they're not there anymore to bring in the revenue or manage the company. The family office is going to be impaired because they were the ones who were making the asset selections and investing and doing the investments and managing the portfolios. Huge destruction in value across the networks. So how do you hedge off mortality risk at the principal level for individuals like that? You have to have life insurance. Okay? You have cash value life insurance, permanent insurance. So part of the money that's being generated goes into paying the premium for a $25 million life insurance policy. If the principal passes away, the estate gets the $25 million. The $25 million is used to basically pre-fund the startups, to keep the company going and hire an individual to run the companies, to hire another individual to sit on the board of the nonprofits, to hire multiple portfolio managers and analysts to take over his or her role in managing the family office, so the money mitigates the damage associated with the loss of the principal. And here's the amazing thing about it, is the injection of the liquidity into the estate, into the portfolio, actually causes the portfolio return to jack. And the beneficiaries of the life insurance policies of the estate actually end up on a higher utility curve, which is where they wanted to be originally. So the life insurance application as a tool to hedge off mortality risk actually gets the beneficiaries in the estate onto the higher utility curve, which is where they wanted to be originally. This is how the rich families on the East Coast and in Silicon Valley do it. They buy a ton of life insurance. And when the principal passes away, there's intergenerational wealth transfer. The life insurance policy takes out the mortgage, takes out the taxes, takes out everything, redistributes the wealth tax-free, and then it just starts an intergeneration wealth accumulation phase. And that's why these families are millions and billions of dollars wealthy because they use life insurance to basically extinguish the liabilities, the taxes, and then give wealth to their heirs and distribute it for them so that they can accumulate more and more wealth going forward. So my recommendation to you is to get life insurance. You can rent for you guys. No, you think it's funny. I mean, if something happened to you yesterday, right, tomorrow, your parents have probably spent $750 to $1 million to get you where you are today. They're basically banking on you, right, to go on and be successful, so that when they become older, you'll be around and you'll have some resources to take care of them. If something happens to you, they get nothing. $1 million life insurance policy on you for 30 years is going to cost you $50 a month. For 30 years, $1 million. That's not even inflation adjusted. So over time, the nominal value, the real value of your premium is actually declining based off of the inflation. So it's crazy. I get people that are your age that don't get the life insurance and something happens to them and their families are devastated. I got people in their 20s that have 2 kids, 3 kids, they're working, they don't have any life insurance. Who's going to take care of the kids? They got to go to foster care. They got to go to the grandparents, go back to the parents. They can't take care of the kids. They can't take care of your kids. So you get the life insurance, something happens to you, your parents are better off, your family's better off. You know, you have to take responsibility. This is the most brilliant product that's ever been invented in the capital markets. And it was invented 167 years ago. It just has a bad rap as insurance. It's probably the most brilliant derivative product ever devised 167 years ago. And the majority of the people don't believe in it because it has a stigma around its name called insurance. If you call it something else, they'll probably buy it. So that's that lecture. Okay. All right, so how much time do we have?